Boa noite a todos, pessoal. Chegamos à nossa palestra final de hoje do nosso Limfie Day, com ele que é professor da Stern School of Business da NYU, é um guru de finanças, um cara que é dos mais conceituados do mundo inteiro quando o assunto é finanças e mercado financeiro. Hoje a gente recebe aqui o professor ASWATH Damodaran.
So now that you can start your presentation, thank you so much for accepting our invitation. It's a pleasure to have you here at our workshop.
Thank you. Hi, folks. How are you? Must be late. What time is it in the evening?
It's 8 p.m.
I have nothing better to do than watch. Let me start with a little bit of history. So it's always good to tell people where you came from before you talk about where you are. I came to NYU in 1986. I was hired as an assistant professor. And they gave me a class to teach. It was a class called Security Analysis, very old class, a class that's been taught for almost 100 years in the US. In fact, in the 1950s, it was taught by a guy called Ben Graham. You've heard of him? He taught at Columbia University. He had a very famous student, and I'm sure you've heard of that very famous student, it was Warren Buffett. So in 1986, they gave me this class to teach, and I take one look and I said, look, I don't want to teach this class, most boring class ever. Because by 1986, it was showing its age. So the head of my department says, well, if you don't want to teach this class, what do you want to teach instead? I said, I'd like to teach a valuation class. And he said, don't do it. Nobody teaches valuation for a whole class. There isn't enough stuff in valuation to fill a class. But I really, really wanted to teach this class. So you know what I did? I said, I told him I'd teach a security analysis class. And I walked in and taught a valuation class instead. That was 1986. In 2021, I'm teaching the class again to 300 MBAs and 300 undergraduates. I teach two classes. And it's the 58th and 59th semester that I'll be teaching this class. And I'm going to say something about this class that captures how I think about valuation. Everything I know about valuation, I've learned in the course of teaching this class. Notice how I phrased it. I know it before I started. I've learned while teaching this class. Let me explain. In 1987, I came back from a day teaching. I looked out of my window, and this was when the NYU's business school was right next to the American Stock Exchange. And I noticed that everybody on the floor of the exchange was on the street. And I said, what happened? Why are they on the street? You know what happened on October 19th of 1987? The S&P 500 dropped 22% in one day. Imagine the Bovespa dropping 22% in one day. That's like a one-day bear market. And the next day when I went into class, you know, the first question was, how do you explain the market dropping 22% in one day? Then you got to the 1990s. Remember what happened in the 1990s, the rise of the dot-com boom. Guess what everybody wanted to know the answer to? How do you value Amazon.com, a company with very little revenues? Remember, Amazon was an online book retailer. Companies with very little revenues, big losses, lots of potential. And guess what? I had to value dot-com companies in class in the 1990s. I tell people that everything I know about valuing young companies, I learned in the process of valuing Amazon in 1997. Then you get to 2008, you have a banking crisis, the world melts down. And the question I was asked in class was, why, if banks are in trouble, does the rest of the world also get into trouble? And we had to talk about the connections across companies. And then you get to the last decade, you have the rise of social media and platform companies. You know what made these companies different? Is the number they presented to the market as the most impressive number was not revenues or earnings or cash flows. It was something else. If I am looking at Facebook, what's the most impressive number about Facebook? Anybody want to try? Let's make this a class. Why should I be the one who talks? No. Mariana, what's the most impressive number about Facebook?
The accountant number or a general number?
Any number. If I were to give one number about Facebook, it's nobody's ever done that before. What's a number about Facebook that makes you say that?
Number of users.
Number of users, right? Their revenues are tiny. There are lots of companies with more revenues. They have 2.5 billion users. What's the most impressive number about Netflix? 200 million subscribers. So in the last decade, the big question I was asked was, how do you value user, a subscriber, a member? And guess what? I had to talk about how to value those in class. What I'm trying to say is, in valuation, as you go through every crisis, every challenge is a learning experience. So you know what happened last year? You in Brazil are still going through it and probably the throes of it. With COVID, markets melted down. And guess what? During the semester, I had to talk about how do you value companies in the midst of a global economic shutdown? How do you value an airline when nobody's flying? How do you value a hotel when every hotel is shut down? So here's what I'd like to do. I'd like to take those 34 years of experience I've had learning valuation and compress it into a few lessons that hopefully will help you when you sit down to value companies. Incidentally, along the way, the country I've been to most frequently in the last 34 years is Brazil. In 2019, when I came to Brazil, it was my 22nd visit to Brazil. You know, the first time I came to Brazil was in 1998. Most of you are too young to remember what Brazil looked like in 1998. So if you complain about how terrible things are now, you should see what the world looked like in 1998. People were still shell-shocked from the hyperinflation of the early 90s. So here's what I'd like to do. I'm going to spend some time talking not about the mechanics of valuation, but the philosophical foundations of valuation. You're saying, what are you talking about? Valuation is all about numbers. Not really. I'm going to lay out some very broad themes about valuation, and I'm going to start with a question that I get asked all the time. Is valuation a science or an art? Anybody feel comfortable being a guinea pig? Because I'm going to ask you this question. So, Diego, are you comfortable enough answering? Unmute yourself if you can. Oh, there you are. You're in. Okay, you ready?
I'm sorry, could you repeat the question?
Is valuation, so the question I'm going to ask you is valuation a science?
I would say it's more of a psychological.
So all you have to say is it's not a science. Let's not even characterize it yet. It's not a science. Is that
right.
fair? All right?
Okay.
Let's make things simpler. Is mathematics a science?
Sounds about right.
It is the only pure science. Mathematicians are convinced that they're the only science. Now let's think about what it is about mathematics that makes it a science. 2 plus 3 is 5. Whether I count my left hand, my right hand, the North Pole, the South Pole, in Brazil, the US, with a calculator, with a computer, 2 plus 3 is always 5. It's not maybe 5, it could be 5. It is 5, and if you get any other answer, you're wrong. The essence of a science is if you get the inputs right, you get the output right. And if you got the output wrong, you must have done something wrong. Mathematics is definitely a science. Physics is mostly a science. The laws of gravity are the laws of gravity. But if the definition of a science, you get the inputs right, you get the output right, valuation can never be a science. You can see why, right? If I said in last November, you're familiar with Airbnb, the company that, it went public in November. I valued Airbnb on my blog. You can go read the valuation. So I sat down to value Airbnb with their prospectus. You know what a prospectus is? When a company goes public in the US, it files financials. So you know what the company did, what its history looks like. So I took its prospectus. I brought everything I knew about valuation into the picture. I did my best to estimate a value for Airbnb. But even though I did my best, is my valuation going to be right? There is zero chance of it being right. In fact, it's going to be definitely wrong. You know why? Because I'm not God. Some of you might be God, but what are you trying to do in valuation? You're trying to forecast the future. We're all going to be wrong. valuation can never be a science. So it must be an art, right? So let's see what a true art looks like. Painting. Not painting your house, but painting hang in the museum. It's an art, right? I still remember taking my oldest son when he was 8 years old to the Met for a Picasso exhibit. So we go to so he's 8 years old, I take him, we come out 30 minutes later and I said, Ryan, what did you think about that exhibit? He said, Dad, I was not impressed. I said, what do you mean you're not impressed? That was a Picasso exhibit. He said, this guy can't get the nose in the right place. I mean, notice that Picasso's, the nose comes out of the side of the head, the top of the head. It's almost like he was either drugged or drunk, which given Picasso's history is probably both. If my son appraised Picasso's, you know what they'd be worth? Nothing. Thank God for Picasso, he's not the appraiser. But for whatever reason, we've gathered together and said, Picasso, he's special. The essence of an art is you really cannot teach it. Great artists are just born. Thank God valuation is not an art, because if it were, I wasted 35 years of my life trying to teach something that cannot be taught. So if it's not a science and it's not an art, what the heck is it? I'll give you the word that I use to describe valuation. It's a craft. I'll tell you what's closest to valuation. It's cooking. How do you master cooking? How do you learn cooking? You could read cookbooks, right? You could watch cooking shows. But trust me, if all you do is read and watch, you will never be able to cook. To learn cooking, you know what you have to do? You have to cook. And the first time you cook, what happens? Fire alarms go off. You will not eat that night. But you learn something about cooking. Every time you cook, you get a little better.
Phone.
Somebody's got the mic.
Ashes.
All right, let me get them. I think I can see who it is. Rodrigo, you got your mic open. Okay, good. There you go. So basically, it's just like cooking, valuation you learn by doing. Every week, I value at least one company. Still learning about valuation every time I value a company. I still remember the first time I valued Petrobras. I called it my disaster company. And I said, hey, this is how a company should not be run, but let me value it anyway. Every time I value a company, I still learn something new about a company. So you know what my advice for you is? Spend less time reading. Spend less time watching. Spend more time doing. We live in a world where it's so easy to keep reading and reading and more research that we don't spend enough time doing. Second big theme that I kind of emphasize in my class is the big difference between valuing something and pricing something. We know what drives the value of a company, a business, an asset. It's cash flows, growth, and risk. That's it. You can dance around these as much as you want, but that's what drives value. We use a discounted cash flow valuation. We're basically estimating the value of something. But most of what passes for valuation out there is not value, it's price. You're saying what drives price? It's demand and supply. Do any of you own the apartments you live in? Rio, it's probably way too expensive, right? Nobody does? So I see a few heads nodding. I don't know whether that means you own the apartment or you don't own the apartment. Imagine that it's 5 years out. You have money, you've decided to buy an apartment in Rio. So you hire a real estate agent, right? The realtor shows you an apartment and then names a price. This apartment will cost you 15 million reais. You're on the beach, basically it's this huge apartment, 15 million reais. How did the realtor come up with that number for the apartment? What do realtors base apartment prices on? On other apartments in the neighborhood that have sold recently and what they sold for, right? That's what pricing is. In pricing, you decide how much to pay for something based on what other people are paying for exactly the same thing or something similar. When you pick up an equity research report, you know how analysts decide whether something is cheap or expensive? They compute a P ratio or an EV. It's a multiple, basically a pricing for the company. And then they say, this company looks cheap because these 15 other companies that look just like it have much higher price earnings ratios. Value versus price. Third thing, most people who walk into my class expect to become Excel ninjas because that's what they think valuation is all about, big Excel spreadsheets. You know how often I've actually opened an Excel spreadsheet in 35 years of teaching in a classroom? Never. Never once have I opened an Excel spreadsheet. To which your response is, how do you value companies without Excel? You do realize that people used to value companies before you had computers. Forget about Excel. Excel is a tool. It's nice. It's very convenient, but it's taken over valuation. So one of the messages I try to bring to my class is a good valuation can never just be numbers in an Excel spreadsheet. A good valuation is a bridge between stories and numbers. People say, what are you talking about? When you value a company and you show me the value of your company, and I look at your revenues in year 10, say, you have revenues of 10 billion reais, and I ask you, well, why are your revenues 10 billion in year 10? The answer I don't want to hear is, it's because I used a 30% growth rate for the first 5 years and 10% thereafter. That tells me absolutely nothing. I need to know what your company is going to do. What's the story for your company that will allow them to deliver 10 billion revenues? Every number in your valuation has to have a story attached to it. And every story you tell me about your company has to have a number that goes with it. Good valuations bridge stories and numbers. And finally, when you value something, you got to be willing to act on it. Let me explain. Let's say I value Natura. Let's say I come up with a value that's 50% higher than the price. You know what I should be willing to do? Go buy shares in the company. If I'm not, what am I telling you? I've done a valuation, but I have no faith in that number. So I'm going to use that word, faith, because that's a prerequisite for you to actually act on your valuations. When you value something, you need to have faith in that value and enough faith that the market will correct its mistakes, that you can go out and act on that. This is the philosophical basis from which everything else comes. Now, having said all of that, let me tell you the biggest enemy of doing good valuations.
Sorry,
Anderson, your
no.
mic. That's okay.
Anderson, você tá com o microfone aberto, Anderson.
Okay, I think you got up, yeah.
Sorry, guys.
That's okay. So I'm going to talk about the biggest enemies of doing good valuation. It's not that you don't have the mechanics. I can teach somebody how to value a company in about 3 hours. But here are the three biggest enemies of valuation. The first is what I call bias. You know what bias is? When you sit down to value a company, you already bring in everything you know about the company into the valuation. If you love Tesla as a company, if you love Elon Musk as a company, guess what? When you value that Tesla, that's going to show up in your valuation. I'll give you a personal example. I valued Microsoft every year since the mid-'80s when it went public. I found it overvalued every single year that I valued it. Strange, right? One of the great success stories of US equity markets that I found it overvalued every step of the way. You know why I found it overvalued? I'm a Mac user. If you came into my office now and were standing behind me, you'd see a MacBook in front of me, an iPad next to me, an iPhone next to me, AirPods in my ears. I've been an Apple user since 1981. And to me, Microsoft has been always the Darth Vader of technology. And if you're a Star Wars fan, I'm talking Darth Vader, not Anakin Skywalker Darth Vader, the really dark guy. I don't like Bill Gates. And when I sit down to value Microsoft, all those bad thoughts come spilling out of me. My valuation reflects it. I hate Microsoft too much to value the company. But you know who else I can't value? If I hate Microsoft too much because I hate, to value the company, I can't value Apple either because I love the company too much. When you sit down to value a company, don't fool yourself into thinking you have no bias. Be honest with yourself. So whether it's Vale or Petrobras or Embraer or Natura or any company you pick, you already come in with your priors into the company. And guess what? Those priors will find their way into your numbers. So that's the first big enemy, bias. Second is uncertainty. None of us likes uncertainty. So we try to avoid it, we try to hide from it, but the reality is we live in a world with uncertainty. And the more uncertainty there is, the more uncomfortable you will get, but you have to learn to deal with it. And the third is complexity. We live in a world where it's so easy to build huge models. And before we know it, we don't know who's running who. Is the model running you? Are you running the model? Bias, uncertainty, and complexity. Keep it simple. Face up to uncertainty and be honest with yourself about your biases. Because if you're not, you're going to end up in what I call the Bermuda Triangle of valuation. You might have heard of the legend of the Bermuda Triangle in the Atlantic. There's this triangular area where ships and boats somehow disappear. The Bermuda Triangle of valuation is where good sense disappears. Bias, complexity, and uncertainty are its three sides. So here's what I'd like to do. I want to take you through two different valuations. I don't know how familiar with valuations are. Some of this might go over your head, but kind of hang in there with the parts that you get and let go of the parts that you don't. You do know that last year was an incredible year for the stock market. Incredible year because it started the year well, but between February 14th of 2020 and March 23rd of 2020, equities around the world lost about 30 to 40% of value. The Bovespa lost 40%, the S&P 500 lost 33%, all in a 6-week period. The world looked like it was ending on March 23rd of 2020. But you know what stocks did over the rest of the year? One of the most amazing comebacks of all time. Stocks made back all of those losses and ended the year up 10, 15, 20%. The Bovespa was up 10%, but the S&P 500 was up 20%. So at the start of this year, people are looking at stocks saying, "Are people gone crazy?" And whenever people look at markets, they look for a metric, something they can use to make a judgment on whether the market overall is cheap or expensive. And historically, in equity markets, the metric that people have focused on is the PE ratio. The way they use it is they look at the PE ratio for the market. The PE ratio for the Bovespa is 12, stocks are cheap. If it's 25, stocks are expensive. I understand that. People want something simple, something they can focus on. But I think the PE ratio is not a very good metric. It doesn't capture all of the different fundamentals you want to capture. So I'm going to give you an alternative metric where I look at what I call the price of risk. And I'm not going to be mysterious here. When you're an investor investing in something risky, stocks, real estate, any risky investment, here's how you decide what kind of rate of return you need to make on that investment. You start with something that you accept as a risk-free rate. Easy in the US, much more difficult in Brazil. What in Brazil is truly risk-free, but you start with that base, right? If I had a guaranteed investment, this is how much I would demand. Think of that as your base. On top of that, you add a risk premium. How big a risk premium? The riskier an investment, the bigger the risk premium. It's kind of a generic statement. Every market has a risk premium, and that risk premium reflects how risk averse we feel and how risky we think the investment is. So for 35 years, I've been looking for a way to capture that risk premium in stocks. So here's the way I estimate risk premiums. And I do it for the S&P 500, but every year, once a year, I also do it for the Bovespa. So as I go through how I do it for the S&P 500, think about how you do this for the Bovespa. What I'm trying to figure out is what kind of risk premium is being built into stocks as they're priced today. So January 1st, 2021, I took the S&P 500 on that date, 3,756.07. I projected out the cash flows I would receive if I, remember the S&P 500 is a 500 US. I estimate the cash flows I would get from those stocks, either in dividends or buybacks,
Tem inglês?
And then I estimate, sorry, go ahead.
Carai.
Professor, can you make me co-host?
I tried and it wouldn't let me do it, so let me.
I'm gonna do a request to be host.
Agora não
I think
sei
it's
se
gonna
pode
make it
enviar.
better to.
Acho que é MR, né?
Matheus
Não, mais
Torres,
dois.
se muta aí, irmão.
No, I
See what
can't do that. Okay. He's
It's
already
not
muted.
letting me do it. Yeah, okay.
Sorry.
That's okay. So basically, I take the price of the index, I look at the cash flows I would get, and I solve for the rate of return that will make the present value of the cash flows equal to the level of the index. At the start of 2021, that number was 5.65%. You see, what does that tell me? If you bought US stocks at the start of 2021, I don't care what you hoped you would make, what you thought you would make, what you prayed you would make. Based on what you paid, you could make 5.65% a year. The T-bond rate was 0.93%. That difference is called the implied equity. That's the price of risk in the US equity market, 4.72%. You're saying, how does that help me? When you look at stocks, the question you're asking is that risk premium enough for me to invest in stocks? You're saying, how would I know? Well, I can give you some history. In 2020, you know what that risk premium number did? It was all over the place. Between February and March, remember when stocks were melting down? That risk premium rose from about 4.7% to close to 8%. By the end of the year, it was back to where it was before the crisis. And if I look at it over a longer time period, this is looking at equity risk premiums in the US going back to 1960. The equity risk premium at the end of 2020 is actually higher than it's been historically, which is a good thing. Because if you're investing in stocks, you want to make sure you're earning enough of a risk premium. So at one level, when you look at stocks, you're saying, I'm feeling okay. The risk premium I'm earning is higher than the risk premium I've earned historically. But at another level, here's a scary feature. Remember that 5.65%? That's what you're earning on stocks collectively. That is at an all-time low. In 1985, if I'd gone to an investor and said, would you accept a 5.65% return on stocks? They'd have laughed at me. You know why? Because you could make 9% investing in T-bonds. You know why 5.65% looks good? Because the alternative is you invest in T-bonds and you make 0.93%. Everything is relative. And we live in a world where our alternatives deliver much lower returns. And in fact, if you look at it playing out in cost of capital, I actually compute the dollar cost of capital for every company listed globally, including all Brazilian companies. At the start of 2021, the median cost of capital for a global company was 5.8%. If you want to convert this to a real cost of capital, the inflation difference is about 4 to 5%. The median cost of capital for a company in nominal real terms is about 9 to 10%. You know what it used to be 20 years ago? 20 to 25%. We've come a long way down in terms of cost of capital as risk premiums and risk-free rates have decreased. So early this year, at the start of this year, I actually decided to value the market. I wanted to see whether the S&P 500 was overvalued or undervalued. And to do this, I need 4 things. I need to make judgments on what the earnings will be in the index, how much cash companies will return, risk-free rate over time, and what an acceptable equity risk premium is. So let me take those one at a time. On the earnings, I actually used what analysts are projecting as earnings for 2021 and 2022 for the index. They're expecting a pretty solid bounce back as the economy comes back. On the cash return, there's going to be a big drop off in 2021, but it's going to come back pretty quickly. For the risk premium, I demanded a 5% risk premium, a little higher than it is right now, but I said I need a 5% risk premium. And I think the risk-free rate will over time climb from where it is, or close to 1% to about 2%. Saying, where's this all going to lead me? Based on my inputs, my assumptions, the value that I got for the S&P 500 at the start of the year was about 3,360. The index was trading at 3,756. I'm not making a final judgment, but to me, stocks look slightly overvalued by about 12%. Does that mean people buying stocks are crazy? Not necessarily. They might have a very different view of the market than I do. In fact, what I did after I did this valuation, was I looked at 6 possible scenarios based on what interest rates do and what the economy does. And here's your best possible scenario for stocks. The economy stays strong, but interest rates stay low. I call this my Goldilocks market. If that's the case, stocks look fine. But if in the other extreme, interest rates rise quickly and the economy is weak, stocks are overvalued by about 40%. Nobody has a monopoly on the truth here. I value the index, you value the index. Neither of us knows whether we have the right value. That's why I said faith is such a critical word. But at least based on my assessment, the market looks overvalued. So now what I'd like to do actually is turn that tool set, bring those tools to value an individual company. Now, before I do this, I want to kind of frame companies in a structure that I find very useful to think about companies. As I describe this structure, I want you to think about your favorite company, and it can be any company, it can be Brazilian, it can be US, whatever company you want, and think about where it would fall in the structure. A startup, so I call this my corporate life cycle. Basically, companies are like human beings. A startup is like a baby. A very young company is like a toddler. Company makes it through toddler years, it becomes teenage companies do. They do what teenagers always do. Every morning they wake up and they say, I have lots of potential. What can I do today to screw it all up? And then you become a company at the peak of your life. Everything you touch turns to gold. And then you know what comes after that? You become a middle-aged company. Who amongst us wants to be middle-aged? You know what middle-aged companies try to do, right? They try to be young again. They get a facelift, they get new clothes, they do an acquisition. Then middle-aged companies become old, and then old companies die. Very morbid idea, but I think companies go through this life cycle. So if I throw a company at you, can you tell me where it is in this life cycle? So let's take a company like Roblox. You've heard of Roblox? It's the gaming platform that went public just a couple of weeks ago. Where do you think you'd put it in this life cycle? It's not quite a baby, right? It's got a company, it's got millions of people on its platform. It doesn't make any money yet. It doesn't have very much in revenues. It's probably like a toddler company. It's making mistakes, it'll fall, it'll get up lots of. Where would you put Tesla? But 2 years ago, I bought Tesla after a valuation I did on my blog. You know how I described it? My corporate teenager. What do I say teenagers do? Every morning they wake up and say, what can I do today to screw it all up? Elon Musk does that every single day. Like just a couple of weeks ago, you know what he did with Tesla's cash, right? Does anybody know what he chose to do with Tesla's cash? What did he buy with the cash?
Bitcoin.
Bitcoin. What? It's one of the stupidest things I've seen a company do. My reaction was, what were you thinking? And then I remembered he's a teenager. He's going to do stuff like this. Where would you put Vale and Petrobras in this picture? Definitely not young companies, definitely not in the peak of their lives, not even middle age. They're probably both walking dead companies, right? What's the future for oil? Can you tell me this great upbeat story for an oil company? I definitely cannot. These are old companies staggering on their way to a deathbed. Terrible thought, but it's a good way to start thinking about the challenges you will face. When you value young companies, the challenges you face are often at the company level. Will the company make it? What kind of management does it have? Will its business model work? You have a lot of uncertainty. As companies mature, you have more history, more to base your valuation. There's less uncertainty. And then you get into decline, you have different uncertainties. Will the company make it? Will it pay off its debt? The amount and the type of uncertainty you face will vary depending on the company you're valuing. And that's where I think it's so critical that you keep valuation simple. whenever I value companies, I argue that the value of any company, whether it's Vale, Petrobras, Airbnb, or Roblox, is driven by a few variables. It's always the same variables. The first is a growth variable. What's your revenue growth going to be? High for Roblox, non-existent for Petrobras. What kind of margins will you have as a company? That depends on the profitability, the business model you have. If you're Roblox, you have a platform, your margins can be huge. You have very little in cost structure. How efficiently can you deliver growth? How much does it cost you? And for Petrobras, how does it grow? It goes out and finds new reserves. It's very expensive. For Roblox, you know how they grow? They acquire customers. Very different kind of investment. Growth, profitability, efficiency. And I measure risk in two numbers. What does it cost you to raise equity? What does it cost you to raise debt? And if there's a chance you will not make it, I capture that in a failure risk. Every company I look at, those are the levers that I value. And remember what I said, it's all about connecting stories to numbers. So here's what I'm going to do to end today's session. I'm actually going to take you through a 5-step process that I use to value companies. And I'm pretty religious about going through these steps. And I'm going to use Airbnb to illustrate how I would use this 5-step process to value the company. First step in the process, when I sit down to value a company, is I think about the story I'm going to tell about this company. The story is going to be different for different companies depending on where they are in the life cycle. Second step, I've got to stop and make sure the story I've told is not a fairy tale. In fact, I asked 3 questions about the story. Is it possible? Is it plausible? Is it probable? Sounds like I'm playing on words, right? But I'll give you a very simple way of thinking about the difference. In late 2017, I was actually in Sao Paulo giving a talk to CFAs. And I was talking about stories and numbers. And I was thinking about what can I ask? There were an audience of 300 CFAs in the room. So I was thinking, what can I ask 300 Brazilians where every person in this room will have an opinion? Clearly, I couldn't ask about finance because half the people in the room were thinking about something else. So what do you think the topic I picked was? If you got a group of Brazilians in a room, what's one topic where everybody in the room will have an opinion?
Football.
Come on. Football. This was 6 months before the last World Cup. So I asked, is it possible that Brazil will win the World Cup? You asked 300 Brazilians 6 months before a World Cup, is it possible that Brazil will win the World Cup? What do you think their answer was? Of course, we won it 5 times before. I said, okay. Then I said, is it plausible that Brazil will win the World Cup? You know what? If I'd asked that question in December of 2014, the room would have been a little shaky. Remember what happened in 2014? I know that you were much younger then, but the trauma is probably still in your minds, right? Remember there was a World Cup in 2014. It happened to be in Brazil. And in the semifinals, Brazil played, remind me again, was it Germany, right? A really close game that you lost 8-2.
7-1.
7-1. I added a goal to each of you. Either way, you lost by 6 goals, right? So, but if I'd add, so you could see in December, but by 2017, you were feeling pretty good about yourselves again. You said, you know what? Team looks much better. You were second ranked in the world. So yeah, it's plausible. Then I said, is it probable that Brazil will win the World Cup? And now you could see the wheels go into motion. If Neymar stays healthy and he doesn't flip and flop and do whatever Neymar does on the pitch, and if this happens and this happens, we get into the right group, then you see, this is how you think about business ideas. Is it possible? Is it plausible? Is it probable? With each one, you're raising the ante. And you're making sure your story passes all 3. Third step, you take that story you've just told me, and remember those levers I showed you, revenue growth, profitability, reinvestment, you convert the story into numbers on those levers. Is it a high growth, high profitability story? Or is it a high growth, low profitability story? I've got to build it with numbers. And step 4, the valuation kind of does itself. And in step 5, you know what I do? I take the valuation to people who think least like me. And I get ready for them to say terrible things about my valuation, and I listen because I want to make my story better. So ready? I'm going to try to use this to value Airbnb. How many in this audience have used Airbnb? Is Airbnb pretty? Are they active in Brazil? Can you rent? No? Have you ever used an Airbnb? Okay.
Yes.
So I want to pick somebody. Lucas, you've used Airbnb? Somebody said yes. I don't know who it was.
Yeah, me sometimes.
Okay, so tell me how Airbnb works. What do you do?
Yeah, I think it's pretty good.
But tell me the process by which Airbnb works. So you're going to go to, let's say, New York next week. So what do you do next? You go on the Airbnb website. You find an apartment you want to rent.
Yeah.
You lock it in.
Yes.
Now, does Airbnb own the apartment you're renting?
Yeah, I think so.
No, actually they don't. You know who owns the apartment? Some guy in New York does. All that Airbnb does is it connects you to the owner of that apartment. That's very nice of them, right? But they're not doing it out of the goodness of their hearts. What do they get in return for connecting you to that host?
You can choose the price too.
They get a percentage of the price. If they're $100 a day, Airbnb gets about $14 to $16 of that $100 goes to Airbnb.
Yeah.
Now you see the basic business model. They're connectors. They're just like Uber, right? Uber connects you to the driver. The driver keeps 80% of the fare. You get a ride, but Uber keeps 20% of the fare. It's an intermediary. That's a pretty simple business. So in November of 2020, they went public. And it was a very strange time to go public, and here's why. Their business model actually worked explosively well for the first decade of existence leading into 2019. You can see the gross bookings go up. The orange portion is the portion they keep for themselves. They had a very good run coming into 2020. And then disaster struck. You know what the disaster was, right? What happened in 2020? The global economy shut down. Nobody was traveling anywhere. You can see that in March and April. Bookings have pretty much disappeared. In April of 2020, they came very close to going bankrupt. Very close. They were able to raise a few $100 million and keep going. And thank God they did, because they made a comeback by November. And by November, they were actually in a stronger position than they were relative to their competition than before the crisis. And here's why. Who's Airbnb competing against? Hilton, Hyatt, hotel companies, right? If you think Airbnb was hurt by COVID, you should see how much damage it did to those companies. So in a strange way, November 2020 was the perfect time to go public. So I decided to value the company. So to value Airbnb, you know, the first thing I need to understand is the business they're going after. They're going after the hospitality business. And I need to get a sense of how big is that business. I can't value a company without knowing the business. So the hotel business coming into 2020 was a pretty big business, about $660 billion in revenues. I want to remember, collectively, all hotels all over the world had revenues of $660 billion. The 5 biggest hotel chains control about 25% of all hotels, the Hyatts, the Hiltons, the Marriotts. The US is the largest hotel business region in the world, followed by China. I don't know where Brazil falls in the mix, but you know, US and China dominate this business. But Airbnb has never considered itself constrained by the hotel business. Airbnb's argument is we'll make this entire business bigger by bringing people into this business that would not have been there in the first place. In fact, as long as 10 years ago, they were talking about how they would change this business, that you would travel more because of Airbnb than you ever did before. In fact, in their prospectus, they estimated their total market to be 3.4 trillion, of which 2 trillion was what they call the hotel market. Do you remember what hotels collectively had as revenues in 2019? 660 billion. Airbnb is making a statement that they can triple the size of the hotel business. It's a pretty big story. And every young company that's gone public in the last few years has done this, right? They've gone into a business. This is what disruptors do. They go in, not only do they take a share of the existing business, they change the underlying business. Uber has changed the car service business. I don't know about how prevalent Uber is in Brazil, but in the US, People have gotten to a point where they take Uber for 2 blocks. I think my son takes Uber to get from the bedroom to the bathroom. I get Uber charges Saturday night, $2. What are you doing? He's probably hired an Uber driver to carry him into the bathroom. It's changed the business. So I'm framing this process, and here's what I'm going to do. I have to figure out how big can Airbnb get? I think Airbnb will succeed, but I have to figure out how big can they get? How much revenue can they have? So I looked at the hotel companies and I was disappointed. The biggest hotel company in the world is Marriott. It's got about 20 billion in revenues. That's not going to do it for me. So I said, it can't be the hotel business. So I looked at 2 other companies that I think are closer to Airbnb. And I'm sure you've used one or both of these companies. One is Expedia and the other is Booking.com. They're pure intermediaries, just like Airbnb. They both have gross bookings of more than $100 billion. Now we're getting a sense of what success in this business will look like. Big gross bookings. Booking.com is incredibly high margins. Why? As an intermediary, your cost structure is pretty limited, 35%. Expedia's margins are lower. You see what I'm doing to value Airbnb? Because I cannot rely on past history. There's not much there. I'm looking at the business, looking at the competition, trying to learn what success will look like. I looked at Airbnb's financials and I told a story. And here's my story for Airbnb. I think they will continue to grow. I think they will change the business. And I think they will grow to have bookings of about 150 billion. That'll make them the largest booking company in the world. I think they'll be profitable, more like Booking.com than Expedia, margins 25%. I do think their side businesses will not take off. And I think they're low risk for a young company. They have an established business model, fairly reliable revenues. And with that story, I value the company. Now, this looks like an Excel spreadsheet, but every number in this spreadsheet reflects a story I'm telling. My booking growth tells a story of a company that's going to get much bigger over time in this huge market. The high margins tell a story of a company that's going to be very profitable. And it's doing all of this with very little investment because it doesn't own the apartments, the houses that it rents out. But the bottom line is, with my story and my numbers, the value that I got for Airbnb was about $37 billion. I did this at the time they filed their prospectus. 4 weeks later, the bankers priced them at about 45 to 50 billion. They went public and they opened at about 65 billion. You know what they're trading at right now? 120 billion. I get at least one phone call or one email every week saying, how do you explain the 125 billion? And my response is, I didn't pay it. I don't have to explain it. I've never felt the urge to explain what other people pay. So don't ask me why Bitcoin is at 50,000. I didn't pay it. I'm not going to explain it. You paid it. You can explain it. It's not my job to explain what other people pay. I'm not saying they're wrong. I'm just saying with my story, I can't see paying 120 billion. People think of valuation as pulling numbers from financial statements and plugging them into Excel spreadsheets. Let go of that notion. The biggest part of valuation is understanding companies and telling a story about the company and letting it play out. And clearly, if my margins are wrong, my growth is wrong, my value is going to be wrong. That's always going to be the case. And in fact, I have a tool called a Monte Carlo simulation. If you've never done it, it's actually a great way to bring uncertainty valuation. That's basically what I've done here, is I've brought in my uncertainty about my inputs into the final value for the company. Any questions? So basically, that's all I wanted to say. So I'm going to open up for questions you might have. And if there are no questions, I'll go ahead, Fernando.
Hi, Professor. Can you see me right?
Yeah, I can see you well.
Oh, so first, it's a great honor for me to be speaking to you. I'm a huge fan. And my question to you is regarding the risk-free rate you've spoken before. So you use the T-bonds for that matter, am I right?
Because I did. Why did I use the T-bond rate?
No, actually, my question is more about.
No, but I want you to answer before you go on, though, because I want to get this nailed down,
sure.
at least for the. Why did I use the T-bond rate? It's my risk-free rate.
Because it's because it's a debt from the federal government of the United States. And
no, because I was doing my valuation in US dollars.
oh yeah, of course, sure.
If I were valuing my company in Brazilian reais, what would I use as my risk-free rate?
Or Selic or CDI.
Would you use that? Are you telling me the Brazilian government bond rate is default free?
Maybe an NTND.
I think that's, so when you think about risk-free, and that's why I said in some currencies, getting the risk-free rate is easier than others. In Brazil, I start with the government bond rate, which right now is about 8.5 to 9%. But then from that, I subtract out a default spread. See why I do that? Because that rate has a default risk embedded in it. Right now, my REI risk-free rate is about 6%. But the risk-free rate used should always be the currency in which you choose to the valuation. A very important lesson in Brazil, because in Brazil, a lot of analysts value companies in US dollars because they cannot deal with local currencies. But if you value a company in reais, you want a REI risk-free rate. If you value a company in dollars, you want a dollar risk-free rate. And if you value a Brazilian company in US dollars, you know what risk-free rate is? The T-bond rate.
Yeah, okay. I think that the T-bond rate, the obviously being in the American government, it's a bond from America.
It's not that it's an American government. It's because the American government can print dollars that makes it risk-free.
Yeah.
Right. Yes. So it's not even that it's see, the problem is in Latin America, which is, let's face it, the center of sovereign default. I mean, more sovereign defaults happen in Latin America than the rest of the world put together. Countries constantly default on local currency bonds. Argentina has done it 4 times in the last 20 years, which is they just refuse to print the money. They said, tough guys, we can't pay you. So in Latin America, especially, you got to clean up local currency government bond rates because there's default risk embedded in them.
I see. Professor, looking forward, I mean, we've watched...
Ei, irmão, tu vai fazer 2 perguntas? Tem bastante gente.
É que eu não tinha feito a pergunta, mas tudo bem.
Então vai lá.
So to be pretty quick, not to take your time, I mean, looking forward, we've seen the increase of the American bonds rates, and obviously the increase of the debt to GDP ratio from America. How can we looking forward to the T-bonds as a risk-free asset? Could we be looking to Asian?
Well, I don't think you can compare across currencies. There's only one risk-free rate in every currency. There's no one risk-free currency. So don't go looking across currencies for something risk-free. There's no such thing as a global risk-free rate. There's only one risk-free rate in every currency. When you do evaluation of that currency, that's a risk-free rate to use.
Perfect. Thank you, Professor.
Marcello?
Hi, Professor. Can you hear me?
Yep.
Great. First of all, it's a great honor for me to be talking to you. As I attended to Stony Brook, I dreamt about attending to one of your classes, so it's a pretty huge deal for me to be here right now. So thank you for this opportunity. Thank you, Limfie, for this great opportunity. So my question is, when I'm forecasting free cash flow, for example,
you don't forecast free. No, wait. No, you don't forecast free cash flow. You forecast revenues, margins, and reinvestment, and free cash flow comes out of those assumptions. Never forecast the bottom line, right? Because the bottom line is the output. And that's one of the problems when people do free cash flow. The most recent end, they put a growth rate on it. They're missing the drivers of free cash flow. So if you look at how I computed free cash flow, I start with revenues. I use margins to get to operating income. And then I subtract a reinvestment to get to free cash flow. The free cash flow falls out of my assumptions about growth, profitability, and reinvestment.
Okay, so my question is, how can we stress test our valuation? How can we stress test the price for market?
What are you stress testing for? That you might have made a mistake?
Maybe the market is making like a huge mistake and I don't trust the market. So
that's why we invest, right? So that's why we invest. So you're not stress testing, you're just doing the valuation. The question you're asking is, how do I know I haven't screwed up on the valuation big time? Okay? I mean, first you check your inputs. Second, you check your story. And if those 2 things work, you have a value. whether you invest, and that's where the word faith comes in, right? There's nothing I can offer you that says, if you check against this, you're going to feel much better. It's why people feel uncomfortable investing. There's no way of checking your answer, even if you do everything right, to see if you got a reasonable answer. You can just check your internal processes to make sure you're being consistent. And that's why I make such a big deal about the story part. The story holds your numbers together. So you can't play with the growth rate and the margins and try different numbers to make the value whatever you want. The key to a story is you now have something holding your numbers together that's more than just a collection of inputs. So think more about the story, because that's what's going to give you enough faith to actually act on your valuations. And remember what I did with the Monte Carlo simulation at the end? Try that out, because that's something that's actually a very good way to, you use the word stress test, to understand how uncertainty will play out in your own valuation.
Thank you, Professor. I've heard you saying before about how valuation is as much art as it is science, and that makes a lot of sense to me.
It's craft.
Yeah,
right?
that makes a lot of sense to me, but I always heard about like stress testing it because the market might be wrong. So
the market. Let me put it this way: the market's always wrong, and you're always wrong. The question is, who's less wrong? None of us gets it right, and that's what I said. You're not God. You're not going to get this right. Don't put that weight on your shoulders. Just make sure you're less wrong than the market. Lucas?
Thank you, Professor.
Só rapidinho, Henrique. Depois de Lucas, eu vou pegar umas perguntas que mandaram no vídeo pra gente, mas agora vai lá, Lucas.
First of all, it's a great honor for me. I want to ask you, how can I accurately measure companies that depends on the behavior of the person? I mean, how will a human being behave in a few years? Like, how can technology changes persons? How the technology will affect business? How can I put this in my model?
Enrique, let me make a suggestion. Have you heard of karma? In India, karma basically means that things you don't control. Worrying about the things you don't control, all it's going to give you is a headache and ulcers, and you're not going to get your job done. I know it sounds oblique, but what I'm saying is stop worrying about stuff like that. You can't value a company if you're worried about how the world will change and how behavior will change, unless you have a company that's trying to take advantage of that change in behavior to make revenues. Why are you wasting your time wondering about the worries of the world? I mean, let's face it, when you're investing in Facebook, what are you investing in? That people will spend increasing amounts of time on social media, and that because they will spend more time on social media, Facebook will make more advertising revenues. So implicitly, we're always making assumptions, but you need to know when to stop, because if you get sucked into that hole, you will never come out. You will never get to actually valuing your company. Because let's face it, none of those things are predictable enough to build into models. If you're really good at forecasting behavioral changes, you don't even need to value companies. You can make money off getting the trend right. Have you heard of ARK, which is Kathy Woods? She was one of the big investors in Tesla. I mean, their biggest strength is calling macro trends, things that they think will happen in the future, and then investing in companies that will benefit from those trends. So if you want to play that game, go ahead, but don't worry about it when you value individual companies.
So I have a
Go ahead,
question.
Lucas.
Current scenario. Good evening, first everyone. Damodaran, it's an honor to be here with you. So the first is how to allocate my morning today in the scenario of so much uncertainty, and Brazilians should invest outside of Brazil. This last question was due to the drop in the value of the real in the global market.
Everything is relative, Lucas. And here's what I mean. In the US, we face less uncertainty now than we did 11 months ago. Could that change? Yeah. If a third wave of COVID hits us, we'll feel more uncertain 2 months from now. Remember I said my first visit to Brazil was in 1998? If you really wanted to see uncertainty, you should have seen how much uncertainty investors faced in Brazil in 1998. Brazil has gone through bouts of uncertainty. So basically it ebbs and flows, right? So there are periods where things have looked good, then periods where things just break. I mean, and the reality is you all face it. It's not just you. And that's something you always need to keep in mind when you do valuation. Everybody faces that same uncertainty. All you can do is the best you can with the data you have. Make your best estimates, be willing to be wrong, and move on when you're wrong. There's, you know, if you say, look, I don't want to be wrong, you can't invest in a market like Brazil.
Yeah, makes sense.
Okay.
Thank you,
Damodar. I'm sorry, Fernando?
Yes, Professor?
Your hand's up. Is that from before?
I'm sorry. Yeah, from
okay. Wow.
Now is Breno.
Breno?
Okay, thank you, Christian. So, Professor, thanks again for your presence. I'm going to read now a question from a person from the audience, a spectator. He's saying that some companies have its image extremely linked to an individual. An individual can not only change his strategy about the company, but can get injured or even die. An example for this is Tesla with Elon Musk. When trying to value a company like Tesla, is there a concern related to this? Is there an increase in the risk considered to this? And speaking a little more, how do you measure this qualitative variable when you have like concentration of, I don't know, decisions in one only person?
Have you heard of a company called Berkshire Hathaway? One of the legendary companies, right? It's an insurance company. Basically, it's an insurance company. And insurance companies are usually very boring. They trade at roughly book value. Berkshire Hathaway used to trade at 3 times book value. Does anybody know what made Berkshire Hathaway special? Bruno, since you're in, what made Berkshire Hathaway special? Why were people willing to pay such a high price for Berkshire Hathaway? Did anybody know what made Berkshire Hathaway special?
Warren Buffett.
Warren Buffett. Well, an individual, right? You know what's happened to that price? It used to be trading 3 times book value to the premium. You know what's happened to that premium? It's gone. Why is it gone? Because Buffett is 91 years old. Markets are not stupid. So you know what happens when you tie your value to an individual? As that individual ages, you're going to see what made your company special is going to go away. One of the things you look for in somebody who builds a great company is whether they build a management team that can outlast them. One thing about it, I told you I hate Microsoft as a company, but here's one thing Bill Gates did really well. He made himself dispensable. He made the company such that he said, you can live without me. He walked away from the company and the company became, and to me, that's what good founders do. They make themselves unnecessary. They create a company that can outlast them. You know, Jeff Bezos officially stepped down from the Amazon management team a year ago. You know why he felt comfortable enough doing it? Because he's built a management team that can keep the company going. My problem with Tesla is Elon Musk is not doing the same thing. It's all about Musk still. Have you noticed this? Do you ever hear anybody other than Elon Musk speak on behalf of Tesla? I don't even know who works at Tesla, to be quite honest. I think it's just Musk and nobody else. That's not healthy. So when you have a company built around an individual, you essentially have a finite life company because your company is only as good as the rest of the lifetime. And God help you if there's an accident or something that takes. I mean, I tell people, look, Tesla, I mean, would you be surprised if you open the newspaper tomorrow and read that Elon Musk has checked into rehab? I wouldn't. I mean, he sounds like the kind of guy who might have to check. Can you imagine what would happen to Tesla's market cap? This is a $600 billion company. It would terrify me as an investor to have that much riding on one person. So the long answer to your question, in good companies, the founders make themselves. In bad companies, where founders are the company, then you worry. Your company will be worth a lot less because of it.
Okay, thank you so much.
Aí, Nível, deixa eu só fazer umas perguntas que estavam fazendo lá no vídeo.
Vai lá.
So, Professor, I have a couple questions regarding GameStop.
Mhm.
So what's your thought on it? How valuation is on it? What's going on? How do you think about it?
What's value got to do with GameStop? Remember they said there are two words, that value and price. What's going on in GameStop has nothing to do with value, right? It's a pure pricing game. And the pricing game is driven by demand and supply, mood and momentum. And in the case of GameStop, revenge, where the Reddit people want to take revenge against the hedge funds want to take revenge against each other. It's a pricing game gone crazy. So trying to use valuation tools to explain what's going on in GameStop will just frustrate you. So it's part of the world we live in, where a group of people can come together on a social media platform and push up the price for a stock. Doesn't make it more valuable, it pushes up the price. And right now the price is being whipsawed by those people. Yeah. So it's not new, it's happened before, it'll happen again. I don't think the world has changed because of GameStop, even though people read big things into it. But it's not the first time this has happened.
Great, thanks. Now it's João and then Julia.
Go ahead.
Hi. I would like to understand, like said, Airbnb, it changed the market. And there are some companies that are doing it right now through apps and digital media. And how we value the game changer potential, because there is some value to it.
Well, I gave it a huge value, right? If this were a hotel company, where would I have stopped? 20 billion in revenues. What did I give them? 155 billion in revenues. That's already a huge shift, right? If the business was stuck at the hotel business, there is zero chance that Airbnb can ever have gross bookings of 155 billion. So when you give these huge revenues to these companies, you're building in the expectation that they're game changers. There's nothing extra you need to do. You just need to step away from the existing business and say, this company is changing the business. So I'm building it in through the gross bookings being a huge number. You see the same thing with Uber. When I give them 100 billion in revenues, I'm giving revenues that no car service company in history has ever come close to delivering. No collection of car companies. Uber alone will deliver enough revenue as the entire car service market delivered in 2009. That's pretty scary if you think about it. So we're building into revenues. So I would keep emphasizing those three levers: revenues, margins, reinvestment, are powerful enough to bring in whatever story you want to tell about a company.
Okay, thank you.
Julia?
Hi, Professor. First of all, I would like to thank for the lecture. It's been a pleasure. And then I wanted to ask how you evaluate our national index, Ibovespa, and if its trading price matches the maturity and the size of our markets.
It doesn't, right? The Bovespa, if you were setting out to create a really bad index, the Bovespa would be it, right? Because and everybody knows it's flawed. It's flawed because it's small, it's weighted badly, it's not weighted based on market cap. There are so many, you can point to all the flaws, but you know why it's going to stay on? Why do we keep reporting the Dow 30? The Dow 30 is a horrible index, but you know why people like it? Because it has a long history. They're used to it. So when you think about why the Bovespa stays on as the index people keep talking about, it's because it's an index we're all familiar with. It's an index we've seen for a long time. And the main reason we look at indices is to get a sense of what are stocks collectively doing, and we go with the familiar. So if I were designing an index from scratch, it definitely wouldn't look anything like the Bovespa. Be market cap weighted, it would bring in young companies. It'll be much wider. But that doesn't mean people are going to use it. So it is what it is.
Okay. Thank you so much.
Right. So first, I want to ask you how much time do you got? What's your agenda like?
About 5 or 10 minutes more. So.
All right. So I have a bunch of questions still, but I want to start with ESG. If you see that that's important or not, if there's a factor your evaluation.
I'll say what I think about ESG. It's the most overhyped, oversold concept in the history of business. You kind of get where I'm coming from.
Yeah, of course.
You know, the reason I don't like ESG is the people who promote it promise. I mean, the way I describe it is they promise cake to everybody with no calories. So they go to companies and say, if you're good, you're going to be worth more. They go to investors and say, if you invest in good companies, you can make higher returns. They go to society and say, if you have ESG, every company is going to do. You can't be all things to all people. Somebody has to lose something. Stop lying to companies. Stop lying to investors. Will being good make you a more valuable company? For some companies, yes, but for other companies, no. If you're Patagonia, small niche company, you know, you go to Patagonia, right? They make these really expensive outerwear. ESG might work in your favor. But if you're Nike, you try to be good, you'll be turning away revenues. You'd probably be hurt by using ESG. We need more honesty on ESG. In fact, I have a paper on ESG and a blog post as well. And the title for both is the same. ESG, do you want to sound good or do you want to do good? You know, right now what ESG is focused on? Sounding good. Every company sounds good. Look how great we are. And in the process, we're missing what ESG should really be about, encouraging companies to be good. And I think that's, you know, unfortunately, the consultants and bankers make too much money of the concept for them to even be honest on this. So that, in a summary, is what I think about ESG. I think it's vastly oversold, vastly overpromised, and I don't think it's going to deliver anything close to what it's offering people.
Cool.
Antonio?
Oh, hello. I've got a question. Coming from Brazil, in a country where political turmoil is like every day, which is the best way to price the political and policy risks when investing in emerging markets, and how to best hedge it while still staying in that market?
You can't hedge Brazilian country risk if you live in Brazil. What's the biggest part of your portfolio, Antonio? It's human capital. It's human capital, right? You're sunk because you're human capital. You can take your investments and invest them in the US, but you know what? At this stage in your life, 90% of your value comes from human capital. In country risk, unfortunately, is going to play a big role in what the value of that human capital is. You know what happens when country risk becomes too high? What do people do when they have lots of human capital at risk?
Capital flight.
They leave. Forget about capital flight. You leave. It's human flight. Capital flight, at least you must get the money back. You lose your brightest and your smartest people because they don't want to risk their human capital anymore. You lose the heart of a country. That's the risk Brazil is running, is its best and its brightest. I'm not going to hang around saying, I'm going to let my human capital go up and down based on what the government is doing. That is the strongest argument for why governments need to try to reduce country risk over time, not keep adding to it. Brazil, the problem is, governments seem to think about what can we do to make the country riskier. It's almost like they've got their entire objective function screwed up. And it's people like you, young people with the rest of your lives ahead of you, who are really bearing the price because your human capital is swinging wildly every time country risk goes up and down. So unfortunately, as long as you stay in Brazil, you are going to be exposed to country risk, even if you get your investments out of there, right? Maybe as you get wealthier, you might be able to do other things, or maybe you'll find a way to make your income outside Brazil and insulate yourself.
Oh, dark but true. Thanks.
Last question, folks. I've got to run after this.
Right. So since it's the last question, I want to know, what do you think about the future of value investing, since we're having so much difference from
the future of value investing is bleak, and it deserves to be bleak because it's lazy and sloppy. Value investing has lost its way. I tell people, if you use the word Warren Buffett one more time, you've lost because you keep talking about a 91-year-old as if, you know, this is like having a team and, you know, the Brazilian team, and you keep talking about Pele over and over again. Come on, it's time to let go. It means you're holding on to old glory. So value investing is still stuck in the 1900s. It's not using the data, it's not using its imagination. The world has become a flatter place. So unless value investing kind of rediscovers a new way of thinking about value, where growth companies can be undervalued, I don't see a way back for it.
Great, thanks. So I want to take a picture. So I have to ask you to stop sharing the screen so we can all go
Let me stop my screen share.
Yes. Let's change the view. Mariana, você está conseguindo ver? Faz a contagem para ele.
Okay. 1, 2, 3. Thank you so much.
Take care.
Thanks for the participation.
Thank you, Professor.
Thank you. Tell me how the Twitch goes. I'm interested.
We had more than 100 people, I think, showed up, and in name of every one of those 100 people here at Zoom, 100 people watching us on Twitch, and in name of everyone from UFRJ, of our Brazilians, we would like to invite you, and you come to Brazil, visit us at UFRJ, at Urca, nearby here.
Hey, you know what? I'm
where
not
the pandemic
right
goes.
now with the virus doing what it is in Brazil.
Of course,
Maybe
of
after all
course.
this is past, right?
But when this situation is over, come here. We will gladly welcome you.
It's one of my favorite countries, and Rio is one of my favorite cities. So no.
You have my email, so you can always let me know.
Okay. Take care.
Thanks again. Good night. Oh,
Thank you,
for
Professor.
you it is good night. So good night to everyone else.
Close.
Yeah.
Bye.
Goodbye. Então, galera, fechamos. Acho que a gente já saiu.
Fechamos. Sigam a gente na Twitch, pelo amor de Deus. Galera do chat, galera do Zoom, tamo junto.
É isso, pessoal. Então, sigam a gente na Twitch, sigam a gente no Instagram também. Eu acho que as redes estão linkadas abaixo da Twitch. Vamos gerar engajamento aí pra liga. Quanto mais engajamento, mais eventos desses aí vão acontecer.
É isso. A gente lançou a Twitch, não foi pra fazer só o Limfie Day, não. A gente vai ter muitos eventos desses aí, vai ser uma plataforma recorrente aí da Limfie. Então, assim, é algo que pelo menos eu não tenho conhecimento. De outra liga de mercado financeiro no Brasil fazendo live na Twitch, eu acho que a gente é o primeiro. Então, assim, vamos continuar essa pegada disruptiva mesmo, porque foi só o primeiro, rapaziada. Vamos que vamos.
Ó, Instagram é Limfie UFRJ, sigam lá, por favor. Acabamos de bater 1000 seguidores, então continue essa construção com a gente.
É isso.
Onde eu acho para seguir vocês, que eu não tô achando?
Ah, ela tá na call.
Tá. Você não quer pôr aqui no chat, não?
Com certeza.
Coloca aí.
Vou colocar.
Coloca o link da Twitch e do Instagram no chat.
Coloca todo mundo coloca tudo.
Todos os nossos usuários são Limfie FRJ, então é só procurar. Ah, foi um evento sensacional.
Desculpa, Rita, o que você falou?
Parabéns para vocês, né, gente? Uau.
Obrigado.
Obrigado, não, pô.
Se Deus quiser,
link aí, vê se você consegue seguir a página.